So you've had some time to digest what happened yesterday. Do you feel as though the green light is there for investors? We're still that far off the lows of the year right now in the markets.
I always think the green light's there for investors, and I always think that now is a great time to be buying if you have cash. So here's something that my younger brother said to me once. I was trying to get him to invest some money, and I was worried that that the market was at a high point. And I said to him, "Benj, you know, if you put the money in now and it goes down, I'm worried that it's going to upset you." And he said, Jenny, have you heard this? Once when an elder was asked, when's the best time to plant a tree? The answer was 20 years ago. And then they said, okay, so when's the second best time? And the best time is today. So I think that it's a great time to be buying today. But I don't think that means that we're in the clear. I don't think it means that we have an easy road ahead for us for the rest of this year. This year's tough, right? We've got hard things like tightening, balance sheet runoff, inflation, supply chain issues, serious problems in Europe. It's really sad what's going on with Russia and Ukraine, and we don't know how the geopolitical fallout of that is all going to play out. On the other side, we have really strong consumers with tons of cash in their bank accounts. We have corporate earnings that are coming in great. By the way, 77% of the companies that have reported so far have beat earnings by 6.5%. We have a really decent economy. So I think this year continues to be a cage match of the forces of like bullishness and bearishness. And I don't know how those play out. But I do think if you have money, you can find areas to put it to work right now and just set it, forget it, sit back, you know, and be patient and let it play out over the long run.
So Jenny, what we've been showing viewers out there and listeners on SiriusXM, what we've been showing is charts over the year of things like the NASDAQ composite, the Dow Jones, the S&P 500. We're still about 20% off the record highs for the composite index. Technology and media is a big part of that particular trade there. Is that where you'd be putting money, in places that are the worst off right now, the ones who've seen the biggest slides?
No, not necessarily. I think you need to be really careful about pinning something and saying, well, just because this used to trade at 60 times earnings and now it trades at 30, it should ever be back to 60. So I think you need to kind of look at each investment as a standalone. And it's interesting because when I look at in our portfolios, our dividend income portfolio and our disciplined growth portfolio, and I tried to cherry pick some names for you today, Dom, and when I look at where I'd put money, they're very disparate, right? So I'd be comfortable with Devon Energy, Dow, National Retail Properties, Thermo Fisher, Carrier, and United Rentals. Those are very different companies. Some of them are down. For example, Carrier is down 27% year to date. I'd be comfortable with that. I'd also be comfortable with Devon, which is up 60% year to date. So it's really not about buying only things that have come down. It's about looking at individual companies on their own merits and saying, my starting point is today. What does this company have ahead of it? What are their earnings? What's their valuation? What's their outlook? It's hard work. Last year, or rather for the last 5 years, you could just jump in because the rising tide was rising all ships. That's not the case. It's company by company. It's hard work. I feel like this is going to be a grind. I think it's been a grind for about a year now. I think the grind is going to continue. And it's really boring, hard work of reading annual reports and listening to meetings and talking to the companies and figuring out what the outlooks really are. But you can't paint with a broad brush this year. All
right. So Jenny, I mean, you mentioned all those names there. I wonder, this is a cliche, right? We often talk about this notion of a stock picker's market. You are a stock picker.
Yeah.
You mentioned those names. Is there a commonality that you're looking for? Is there one factor in particular, or maybe two, that really sets you off as saying that this is going to be the company I want to invest in?
I think this is a hard one because there is a commonality, but basically it's this. Is the valuation rational? And are the expectations achievable? And so I think when you look at some of the stocks that are down a ton, like a DocuSign or like a Peloton or like a Zoom or like a PayPal, I'm not sure that the expectations going forward for those are achievable.
Sure.
People still have really inflated expectations. Whereas, here's one that I didn't throw out before, but Marriott, for example. Marriott's trading at 24 times earnings.
Gotcha.
But analysts are clearly underestimating the speed of recovery of their earnings. So even though it's not below a market multiple, the earnings growth is totally achievable.
Right.
And that's what I want. We need to be able to beat things.
All right. Jenny Harrington with the stock list. Thank you very much. Have a good day. We'll see you soon.